We think it's probably too early to say the inflation dragon has been slayed, but inflation is cooling and the Fed is backing off at the inflation fight and is shifting into easing mode. In fact, there's growing concern that the Fed has tightened too much already. The bond market's worried the Fed needs to cut faster and do more than the Fed has forecast. I think the challenge here is that it's hard to know in real time whether the Fed is in fact behind the curve. We know that monetary policy works with long and variable lags, as the saying goes, but it's difficult to pinpoint whether the Fed is being too restrictive. And that's what the market and frankly the Fed are struggling with right now and trying to get right. So for now, we think it's no longer all about inflation. The risks are two-sided. It's about inflation and the economy. And with the economy, it's about the consumer and jobs. The US consumer drives US growth and arguably world growth. And consumer spending is held up pretty well. Consumers are benefiting from steady income gains, positive wealth effects from rising stock and home prices, and some savings left over from the COVID support programs, although that impact has mostly faded in our opinion. Now, we are starting to see some stress in the consumer, especially at the lower end of the income spectrum. That's where credit is expensive and has become less available in some cases. So that's an area of concern. But we think as long as employment holds up, we think consumer spending should continue to be supportive. On the employment front, the employment picture remains healthy, but here too, we are seeing some softening. Job growth is slowing, wages are moderating, the unemployment rate has ticked up. The question is, will an economic slowdown lead to job cuts? We see broadly that companies are losing some pricing power. That's the flip side of lower inflation. But that could mean lower profit margins and the need to reduce labor costs through layoffs. Now, we haven't seen that in a big way yet, but markets are going to be closely watching how this employment consumer spending dynamic plays out. In sum, too early to write off inflation concerns entirely, but the focus has shifted to the growth side of the equation. What does this mean for markets? Well, we think it's a positive for fixed income investors. A market driven by a more balanced inflation and growth outlook, we believe allow bonds to provide their traditional role not only as a source of income, but as important as an offset and diversifier to investors' equity positions. Now, we saw that play out in early August when bonds really did their job, and we expect that trend to continue.